So you want to jump into the world of crypto, which is great, but you really should do it only if you understand what the heck you're doing. If you understand the market. Here's the thing. Crypto is a huge space and it's unique and it's some of the craziest things you'll see in investing. Of course, this is a Wild West, and that Wild West, while chaotic and crazy and dangerous, are also where the big gains are to be had. But you need to have a handle on the basics to make sure you don't end up losing all your money. And that's where this guide comes in. This is a crypto rundown for you focused on trading and investing so that you can navigate the market, you can stack some profits, and you can reduce some risk. There are 10 parts in all, and together they're going to give you a strong foundation. So you need to watch this video the whole way through, especially if you're new. There's so much information here, you can't miss anything. So let's start with the difference between Bitcoin and the rest of cryptocurrency. And by the way, there's a lot of basics covered here. Maybe you'll want to skip ahead to some different topics if you're already familiar with some things, but do watch the whole video, especially if you're new. Anyway, one question a lot of people ask is, well, WTF are altcoins? You see, the crypto story goes all the way back to 2009 when Bitcoin launched. It was the first blockchain, but over the years, there's been an explosion of alternative chains. When we talk about altcoins, we're referring to these other currencies. Altcoin simply means an alternative coin to Bitcoin. And basically that means everything that's not Bitcoin. Now you might be wondering, why not just buy BTC and forget about it? Well, you can do that. Of course, it's the first, it's the best, and it's gone from zero to, well, over $100,000 in 2024. Where it goes in the future, who knows? Well, here's the truth. Crypto has made many millionaires, and many more investors have made six-figure, even seven-figure gains. And yes, once upon a time, Bitcoin was how large profits were made. But now, if you want that life-changing money, it's not going to be Bitcoin. You're going to need to risk life and limb in the altcoin jungle because there is definitely more risk. But don't worry, we can chart a path here to try to make it a little less treacherous for you as a new investor. And before we dive deeper into that topic, please do note real quick that throughout the video, we'll be mentioning recommended partners like BitUnix, our recommended cryptocurrency exchange for people globally. Also, we have Ledger wallets, which are our recommended security devices right here. And you'll also be hearing mentions of our newsletter throughout the video. You can find links for all that stuff down below in the description. Thank you for supporting us by supporting our affiliate partners. If you do appreciate this information, and of course, sign up to our newsletter. Now, let's break down the different varieties of altcoins. So first we have layer ones. These are complete blockchains with their own tokens, like Bitcoin, except not Bitcoin, because Bitcoin's just Bitcoin, right? Big names here you might already know. Ethereum, Solana. There are also newcomers out there, Aptos and Sui, and there are layer 2s built on top of some of these things, and even layer 3s in some cases. Layer 2 blockchains are simply scaling solutions built on top of things like Ethereum to allow for faster, cheaper transactions. Now, we're throwing out a lot of stuff here too. We're not sort of getting to the basics of blockchain and stuff like this. We're just talking about investing in crypto assets in here. Just keep that in mind. Now, these things usually have their own tokens, by the way, and contenders can include Arbitrum and Optimism and Base, although Base does not have its own token at the time of recording this video, may never. Anyway. We have layer 3s. It gets really complicated real fast. As you can see, there's so much going on, but layer 3s are built on top of layer 2s, and they're more app-specific things like degen on Base. Then we have stuff like utility coins, guys, just to understand the sectors, right? We have utility coins. This is a useful way of grouping blockchains with special utility, and I'd suggest 3 main types to grab your attention here. First, we have oracles, things like Chainlink that let blockchains pull data in from off-chain sources. We have storage coins like Filecoin that facilitate decentralized data storage. And we have privacy coins like Monero that make transactions opaque and untraceable. Then, of course, the most popular sector, meme coins. This is a huge category of the cycle. Meme coins have zero utility. Some of them have had a little bit of utility on later, but generally they have zero utility. They really just trade purely on attention and hype and speculation, and there's been an explosion of new ones. The vast majority, of course, which are completely worthless, while a tiny handful have created many new millionaires. The oldest meme coin is Dogecoin. Shiba Inu is also one of the biggest. We have newer contenders coming in like Pepe and Dogwoof Hat. And of course, memes have been crazy. And a lot of money's been made on memes, but a lot more money's been lost too. Then we have stuff like gaming tokens. These are connected with Web3 games. Things like Off the Grid or last cycle's big title Axie Infinity. Another category that has become super popular, has made a lot of money for a lot of investors, AI coins. Now, currently a major narrative. There are several AI-related crypto projects, and probably dozens or hundreds at this point, for being honest. The big things that get a lot of attention, like Tensor or the Artificial Superintelligence Alliance. These are bigger players in that space. We have a newer trend picking up steam, that's RWA. So RWA means real world assets, but bringing them on chain. Think about stuff like treasury bonds or gold or real estate brought on chain. A notable project working in that space is Ondo Finance. Then we have decentralized finance tokens. So decentralized finance, or DeFi, is an expansive and complex place, and many protocols have their own native tokens, including Uniswap and Jupiter on Solana, Aerodrome on Base, as well as newer entrants like Bitcoin, Rune tokens, and stuff like that. Now, in the last couple of years, we've seen the introduction of fungible tokens deployed onto the Bitcoin network as well, with two different standards in operation. We have BRC20s and a newer type called Runes. Again, we're throwing a lot of information at you here. If you're more interested in these topics, you have to go deep dive on any of these topics. This would be a 10-hour video if we tried to deep dive everything here. It's already going to be over an hour. So anyway, those are some of the most popular types of narratives right now. We also have social finance apps. We have decentralized physical infrastructure network, or DePIN coins. We have RPCs and data layers and play to earn games and metaverse and just decentralized science. The rabbit hole goes super deep, okay? But that covers the basic idea. There's altcoins, there's a lot of different categories, a lot of different niches, a lot of different use cases being fulfilled. But there are one more mega important category to know about, and that's stable coins. These mean tokens pegged usually to the US dollar, sometimes the British pounds or Japanese yen or whatever. So they have an unchanging, well, mostly unchanging value. They are supposed to be pegged. The biggest being USDC and USDT. Now, you can use these to earn yield and decentralized finance, or just to store value in fiat on chain. Also worth mentioning, of course, NFTs, meaning non-fungible tokens. So each single token is unique and often linked to an image file, like a monkey picture. The top collections are things like CryptoPunks and Pudgy Penguins on Ethereum, but there's also NFT-like tokens on Bitcoin that are called ordinals. Solana has NFTs. Basically, every chain has NFTs. And that's the shape of the landscape right now. There's a lot going on. There are profits on offer everywhere, but it's risky and unregulated in many cases, and that means you can lose money. And about 90% of altcoins will go to zero, and a huge percentage of NFTs and stuff like that will go to zero in a very short amount of time as well. Of course, that means you can lose a lot of money like that. In fact, 90% of the altcoins you're going to see in this cycle are going to go to zero in the bear market. A similar rate as you're probably going to find in the venture startup world. These are, after all, startups. Don't be fooled. And don't rush in, okay? And do expect to make some mistakes. In fact, one factor often leading to so many errors in crypto is the crazy pace that things are happening, combined with FOMO as the market pressures you to essentially act now, risk more, bet more. Actually, though, that fast pace means there's less need to rush, because guess what? If you miss one opportunity, there's always another bus coming, okay? You never want to become exit liquidity for earlier investors and buy the hype chasing big green candles. It doesn't usually work out very well. Also, there's a lot of genuine excitement and enthusiasm in the crypto space more broadly, but there's also a gargantuan amount of bullshit flying around. So always be skeptical. Always take everything with a pinch of salt. Remember, most people have bags. Most people have a narrative. Most people have a reason for talking about the things they want to talk about. So keep that in mind, okay? Everyone's got an angle. That all said, though, we can still stay focused on the positives. Are there scams and hot air? 100%, obviously. But there are also some incredibly innovative Web3 companies actively defining the future of finance, which is probably why you're here. You want to invest in those. And crypto is absolutely the most open and accessible investment space that has ever existed, offering a constant flow of financial opportunities for savvy investors like you. By the way, I just want to take a quick second to let you know about the Wealth Mastery newsletter. Remember, I mentioned that a few minutes ago. This is, by the way, the best damn newsletter in the cryptocurrency business. So we are trying to help you out to stay ahead of the curve. See, every week, me and my team of researchers, we are working hard to bring you guys the latest on not just Bitcoin, but altcoins and decentralized finance and meme coins and AI and NFTs and much, much more. At the time of recording, we had about 150,000 people a week reading this, and you can start getting it for free. It's a fantastic resource to help you stay up to date with what's going on in the market, especially if you're new to the market. Link down below in the description. Thank you very much. Back to it. So let's find out about understanding the cycles. One of the most fundamental aspects of making money in crypto is understanding the market cycles. Of course, cycles are not unique to crypto. Cycles happen in all markets. In economics, a cycle comes from the time period between two price points. highs and lows for any given asset or sector, resulting, of course, in price action that moves in relatively predictable waves, or at least we hope so. As for why these cycles occur, it comes down to largely human emotion, as markets are ultimately expressions of crowd psychology and sentiment. Maybe that'll change over time as AI takes over more, but the key drivers right now in markets are fear and greed. When the overriding emotion is fear of losing money, prices fall, and there will be a drawn out bear market bottom eventually coming in. As sellers offload risky assets and potential buyers remain sidelined, waiting for better conditions. And when greed is dominant, the opposite, of course, occurs. We see new buyers rushing in. Everyone's getting rich, and you want to as well. Everyone's eager to grab some upside. Everybody else making money, must be easy, I should get into. While holders refuse to sell in expectation of new highs, of course, which as a result drives the price to newer highs. You've probably seen the Wall Street cheat sheet before, if not, here it is, which maps out the emotional roller coaster in more detail. And if you put this over top of a lot of charts of a lot of assets, you're going to find a strong similarity playing out. Pay attention to it. Okay, we also have stuff like the Fear and Greed Index, which tries to capture general market sentiment. Knowing all this, if we try to look at the bigger picture and to play the long game, we can actually profit by acting early and counter trading prevailing emotions. And in fact, that's exactly what smart money does, accumulating during periods of fear, holding as sentiment shifts, and selling into retail greed. They accumulate in accumulation periods, sell during the markup and distribution periods. Most investors, retail investors, only buy during the distribution periods when early buyers are selling to them. That said, though, actually hitting the buy button at the market lows can be tough. It's scary. You'll be surrounded by doom and gloom pronouncements of the death of crypto, the death of all markets. Everything's going to go to zero everywhere. And selling into greed is also surprisingly difficult, as you'll feel like you're missing out on further gains. You're a genius. It's going to keep going up. It'll double again tomorrow. But this is what trading is all about, overcoming emotions and sticking to the plan. And if we look at the various phases of a cycle and check the Bitcoin price chart, we can actually try to figure out what stage it looks and feels like at any given time. And by the way, charts are important, but as we're talking about psychology, gauging feeling is pretty important too. So you should keep tabs on social side of crypto, which is mostly centered around X, formerly known as Twitter, to check sentiment, see how people are behaving, see what people are saying, see what kind of delusion you're seeing on the timeline today. Although crypto has some pretty unique patterns, the key asset, of course, is Bitcoin, which moves in an approximate 4-year cycle, correlated with Bitcoin halvings and broader credit cycles, which happens approximately every 4 years. So we tend to get an accumulation year, an early bull market year, a full bull market year with a blow off top, hopefully sometimes a rounded top, and then a huge crash and bear market year. But also there are cycles within cycles. For example, first, Bitcoin moves, then capital flows into Ethereum, then into other major altcoins, and finally into riskier and more speculative coins, and even further down the risk spectrum, NFTs and meme coins and all that kind of stuff. Plus, specific sectors will pump at different times. For example, AI coins will pump around big NVIDIA news. Gaming coins will pump hard off of some particular game doing well. The hot ball of money can rotate around pretty quickly. This kind of sector rotation can be pretty unpredictable, so it helps to be locked into some crypto socials and get a sense of how attention is shifting. Also, look out for catalysts that can pump a certain sector, with a good example being the surge of prices of metaverse tokens when Facebook back in 2021 rebranded as Meta. All the metaverse tokens took off for a couple of months. In that case, it was a rather short-lived pump, highlighting the importance, of course, of taking profits when a sector is getting too gosh darn crazy. Artificial intelligence is another great example. The launch of ChatGPT kicked off a major AI trend in crypto, one that's basically continuing to go. However, there are also some counterpoints to keep in mind here. One is that cycles can be disrupted, and past performance does not equate to future performance. This year, we've already seen some unprecedented stuff, so 2024 is crazy. Bitcoin hit a new all-time high before the Bitcoin halving on the back of the ETF hype. Well, previously, new all-time highs only came months after the Bitcoin halving. This is almost certainly, of course, due again to that Bitcoin ETF hype opening up for business, and those products may have further disruptive effects from here. We also saw things like meme coins running super hard. Well, the bigger altcoins underperformed for a very long time, which is a bit unusual and gave us a period in which a barbell portfolio of Bitcoin and micro cap dog coins was really the ideal setup. Things can be crazy out here sometimes. What's more, the stronger the consensus that something will happen, the more we should probably consider that a different outcome might actually unfold. So for example, if everyone knows for sure that Bitcoin will peak at a certain time, at a certain price, consider that it might then peak earlier as traders decide to front run the crowd, thereby actually dragging the peak forward. Or the opposite happens and it actually blows past everyone's expectations and catches everyone with their pants down because everybody sold too early. Finally, there are no guarantees about the future, especially with Bitcoin growing in size as an asset. Although that said, human psychology does remain pretty gosh darn unchanged. Whether we're trading barley or blockchains, you see similar patterns playing out. Now, before we get into the best and worst times to buy, I wanted to let you know that we also have some amazing courses available if you want to go even deeper, learning about altcoins or Bitcoin or even how to trade, read charts, all that kind of stuff. You're gonna find links down below in the description to those. Okay, so now that we've looked at market cycles, you can see that crypto, a lot of it's about timing. You need to buy low and sell high. These things sell off dramatically in bear markets. So you need to try to identify the best times to load up, and you can use the cycle timing more broadly. Now, here are some more detailed signals identifying that it's the best time to buy. Number one, of course, a social signal when everyone says that crypto is dead. These are articles about crypto's collapse, podcast guests declaring that it's all over, pithy tweets as people are like, oh, I was right the whole time. See, crypto's gone to zero. But these pronouncements are often completely misguided victory laps from people who always hated crypto anyway, have missed out on gargantuan amounts of gains just to be right once every 4 years during the bear market. Number two, when no one wants to even hear about crypto, let alone to buy it, is the best damn time to buy it. After the crypto market bottoms and the obituaries have been written by all the mainstream media again, there's the wintry bear market grind, at which point no one even mentions crypto. You mention crypto, you're looked at like a crazy person, a pariah. Tokens will have as much mainstream appeal as a decaying plague rat. But these tumbleweed moments are literally the best time to buy, okay? When your brain won't want to, but it's when your pocketbook should. Number three, when chart indicators flash oversold signs. Technical analysis can provide some pretty useful signals, so look out for things like the RSI flashing oversold on the weekly, which is more important than the daily. Daily is more for short-term stuff. Weekly is much bigger trend stuff. The MACD making a bullish crossover after a correction. And in the case of Bitcoin, you can look at stuff like the hash ribbon indicator, which is a free indicator you can find on TradingView. So these give you a good indication of when it's a good time to buy. So learn about these things. Number four, when the market is ranging at the lows. The market's crashed, then it crashed some more, maybe even a little more after that. Prices are now ranging sideways. Everyone's licking their wounds. It's all bad and terrible. But that's the perfect opportunity to start loading up. This is the beginning of the accumulation period after the worst of the crash. Number five, when markets break out of the range. By waiting for BTC to break out of the lows to the upside, signaling the market structure is shifting, you might avoid some of the risk of further dips. Now, you're not going to get as much gains, but you'll probably avoid a bit of the risk by confirming that the market is indeed turning around. And even if you miss out on the deepest discounts, it's fine. There's always money to be made, and there's still a very long way to go, even at this point in the market cycle. And it's not an all or nothing situation when it comes to investing. You can DCA into Bitcoin, so dollar cost average, buy $50 a week of Bitcoin for the next 10 years, not think about it. Or just load up periodically during the worst sell-offs and bear market periods. There's a lot of different ways to approach it. So that tells you when to buy. But how about the opposite? Well, here are some signals telling you when it's the worst possible time to buy, or in other words, these are signals telling you to sell. Okay? Number one, when crypto hype is everywhere. This is the exact opposite of during a bear market, as suddenly there are articles across previously uninterested mainstream media now focused on crypto, and everyone's getting hilariously rich. Prices are sky high. Everyone's a genius. The media is the worst. Number two, when crypto accounts start posting photos of cars and watches that they're buying from their big gains they just made on their big trades. If you start seeing crypto big shops showing off their new Rolexes and Pateks and Lambos and Ferraris, then you are receiving a dazzling sell signal. In fact, those accounts already sold. They've already cashed in. That's where they got the money for the Lambo. You're already late. Number three, when friends and relatives start asking you about what dog coins they should buy, or even worse, giving you tips about what dog coins you should buy because you're into crypto, right? Your cousin you haven't seen for a year fires you a message asking your thoughts on the latest vaporware dog token that already pumped 10,000x. Should I buy it now? Can it go another 10,000x? Oh, they want to know if they should buy, and the answer is probably no, they should sell, but they're probably not going to listen to you. They're just looking for confirmation bias. Number four, when the Coinbase app is the #1 app in the App Store of all apps. The higher the Coinbase app goes, the nearer we might be to a cycle top as retail floods in. And you can keep tabs on other crypto apps too, including wallets like Phantom or the Crypto.com app. Number five, when technicals flash overbought signals. Again, technical analysis is your friend and can definitively help you in your buying strategies and your profit-taking strategies. And again, we have a course on trading to help you identify these things down below in the description. So at the cycle top, we can look at the monthly RSI. If it hits 90 or more, the market is getting crazily overbought and it's a sell signal, 100%. When you see a bearish MACD crossover on the weekly or the monthly, definitely is a big confirmation you need to be out of the market. If you're waiting for the MACD monthly bear cross, you're too late. MACD weekly, still a good time to get out. Also be aware that with newly launched tokens, the first hours of trading can be enormously volatile and it's easy to get burned during that period, and it's generally not a good time to buy. Remember that you don't need to FOMO into every new thing. No matter how much mind share it might be grabbing at that moment, it's usually grabbing that because people are all hyped up and excited buying the tops while smart money is exiting. And a quick reminder, these buy and sell signals mean going against the crowd and counter trading your own emotions. Think about everything I've just said. You have to go against the crowd because the crowd wants to buy the top and sell the bottom. And that cannot be you if you want to win. At the top, the vibe's euphoric, man. The last thing on your mind is cashing out and leaving such an amazingly fun party. But in the reality, the party has to end sometime. And it's way better to be out a little bit early and headed home rather than staying and cleaning up the mess the next morning as you wonder, well, where did all of your money go? It's gone. Now let's move on to the nitty-gritty of how to actually buy. Now, the easiest way to get started in crypto is simply by buying some Bitcoin and then taking it from there, because at first, you just need to get off of zero and start building a portfolio. So let's run through the basics here on how you can do that. And we're going to be using BitUnix in this example, which is a centralized cryptocurrency exchange. For those of you in the USA or the UK, you're also going to find a link down below to crypto.com, which is also a great place to buy and sell the top crypto coins. We also have a link for Bybit down below, which is another great option along with BitUnix. So got a lot of choice. We're going to be talking about BitUnix today in this video. So the steps are pretty similar for BitUnix as crypto.com and Bybit and all that stuff. So watch along. You'll get the general idea of how to buy some crypto. So step one, you need to sign up. You can do that using the link down below. Plus, you'll get some exclusive trading and deposit bonuses if you use that link. So go check that out. So click the link, then click sign up to make a new account, okay? Very easy, usual basic setup stuff here, okay? Enter your email address, make a password, you'll get a confirmation code to your email that you need to then go enter in, and your account is going to be created. All usual stuff, there's no surprises here. If you already have any crypto in a wallet somewhere, well, you can actually then just transfer it over to your BitUnix wallet. But we're talking about how to buy here, okay? And in order to buy through BitUnix, you're going to need to complete KYC. But do be aware, at BitUnix, you're actually buying through a third-party service provider. Also, please note that BitUnix is actually a no KYC exchange when it comes to crypto trading. So if you deposit USDT or Bitcoin or something like that, they're not going to take your KYC, your customer stuff, your ID and all that stuff. If you deposit crypto and trade crypto only, then no need to do KYC unless you want to withdraw more than $500,000 a day. And if that's you, congratulations, okay? But if you want to buy crypto directly using fiat, like your credit card and stuff like that via BitUnix, then KYC will be required here. Now, To do all this, first hover over your user icon and select KYC, and you'll go through the identity verification page where you can click verify for basic verification. Then you need to select your ID type. For example, a passport or a driver's license, and then fill in your personal details. By the way, it's gonna be the exact same stuff over on Bybit and the exact same stuff over on crypto.com, okay? You're gonna need to upload a photo of your ID and a photo of yourself holding it, and then you may need to wait up to 3 days for the process to complete. Now, when you are verified, you can then go to the Buy Crypto tab, enter how much you want to pay and in which currency, enter the cryptocurrency that you want to buy. So for example, BTC, select a provider and your method of payment, and then click buy. After which you will need to go through a standard payment process. When that's all done, the Bitcoin will be transferred over to your BitUnix wallet, and that's it. Congratulations, you are now a Bitcoiner. It's a lot easier. Much easier these days to buy Bitcoin than it was when I started back in the day. Just a couple more points here though. First is that you don't have to buy Bitcoin. Bitcoin's great. I love Bitcoin. It's my biggest portfolio holding. But there are multiple coin options out there to buy, including Solana, which we're going to use in the next section. And you can also buy stable coins, which again are those tokens that are pegged to $1. By holding stable coins, basically have cash on chain ready to trade for crypto whenever you like, which can be super useful, by the way, to have some extra stable coin just sitting around. Also be aware that you're still not actually holding your own crypto in self-custody, and the exchange is actually taking care of it for you, which is fine for smaller amounts, or if you're actively trading on the exchange, it's okay. You need to have money on the exchange to be trading. But if you're holding for longer term, or you have big profits when you cash out in Bitcoin, then you can transfer it over to a hardware wallet like a Ledger, linked down below in the description. Of course, these are fantastic wallets and a great way to hold any serious amount of cryptocurrency for the long term. And if you're interacting on chain, you'll need your coins off of the exchange as well, and to put in your own wallet. On chain means that instead of trading on a centralized exchange, you're actually trading across blockchain networks. But we're going to go through that process in the next part, so hold on for that. Now, if you're keeping your coins on the exchange, then make sure that your security is strong by going to the security page and setting up the Google Authenticator, meaning you'll need the Authenticator app on your phone, along with any other additional security features that you want to have active. Going a little deeper, another way of buying is to actually invest in token sales at the launch before the token is listed on exchanges. Now, this kind of early investing can offer potentially very substantial returns, but it's also risky, and you need to fully research new projects and terms before you invest. And to be honest, for the most part, regular investors are not able to get into these things. Look, if you're investing in any kind of startup, you have to spend a lot of time researching before you put your money on the line here. Also, there's a lot of regulatory barriers depending on where you're based. Again, meaning that a lot of people cannot participate, certainly not if you're in the USA, at least based on current regulations. There's also minimum limits of how much you need to invest. Now, if you're interested in exploring this route, then my suggestion would be to go to the CoinList platform. Again, not for US people or Canada or even the UK, because your regulators love you so much. They want to protect you from getting into early startups. But anyway, the CoinList platform lists a lot of early coins. Solana, for example, was a CoinList pre-sale. There's also Seedify, which is especially focused on Web3 gaming, a platform called Based VC, which is aiming to open up early stage investing to retail participants, and a lot of other stuff, Fjord Foundry and quite a few others. But CoinList has had the best over time. So let's look at moving your crypto off the exchange. So you bought some crypto, now what? Okay, let's get on chain, which means let's use blockchain networks to actually do stuff on crypto, right? Holding high conviction coins is fine, but there's a lot that you can do on chain. And for example, let's focus on Solana, including how to use the Solana Wallet Phantom and the Solana Decentralized Exchange Jupiter. This is where you find all the early stuff, by the way. If you're waiting for things to get listed on a centralized exchange, you're late, okay? First, you need some Solana, but as mentioned, you can buy this on BitUnix in the exact same way that you buy BTC, but instead selecting SOL instead of BTC when you make the purchase. Then we're going to send SOL from the exchange to our own Solana wallet. So of course, you'll need to set up a wallet first. And the top choice on Solana is Phantom. So you can go to Phantom, PHANTOM.app, and select a desktop browser version or a mobile version, depending on what you want to do. You'll be taken to the relevant web store. Once Phantom's installed, open it up and select Create New Wallet. You're going to be set a password here, which you'll be using all the time. But the other very, very important thing that is unique to crypto, and is a bit of a learning curve for some people, is that there is a secret recovery phrase, also known as a seed phrase. This will be generated automatically for you. And this consists of 12 words, sometimes 24 words on different wallet providers. You need to write them down in order and then store them safely, because that phrase, and only that phrase, allows the wallet to be restored on any device that can download the Phantom wallet. And you alone are responsible for your own wallet. So take that 12 words, make a second copy of it, and put those somewhere very, very safe where only you know where they are and only you know what it's about, okay? So with Phantom set up now, let's open it up, click on Solana, and click on Receive, and copy your new Solana receiving address. Then back on BitUnix, or whichever exchange you choose to use, whether that be crypto.com or Bybit or whatever, go to the withdraw page, select Solana, make sure you're definitely on the Solana network, okay? Paste in the Solana address you took from Phantom as the withdrawal address, and then select the amount that you want to transfer and send it across, and it'll be there in a minute or two. Now that Solana will appear in your Phantom wallet, again after a minute or two, and that's it, congratulations, and you're now on chain, right? You're looking after your own crypto in your own wallet, and you can now actually use that crypto to interact on chain. So let's do some of that. If you want to stake your SOL to passively earn more Solana, you can actually do that in the Phantom wallet by clicking where it says Start Earning SOL. But let's actually connect up now to a Solana decentralized exchange called Jupiter to get an idea of how that works. So Jupiter lives on the Solana blockchain. So when you trade on Jupiter, you're trading on chain from your wallet, right? No centralized players, just software. So go to jup.ag, click on Connect Wallet, and we'll look at how to do a simple token swap. In the swap tab, you just set a trading pair, for example, SOL and WIF, which is WIF, dog with hat, and set the amount that you want to pay, click swap, and you'll then need to confirm the transaction in your wallet. In fact, get used to confirming transactions like this, because that's something that you have to do all the time when you're interacting on chain, because that's how you confirm the transfer of assets from your wallet to another wallet or to make an exchange or whatever else you might be doing. Something to also mention here is something called slippage, which means the variation between the rate that a swap goes through at and the rate when you initiated the swap. So for example, an order placed at $100 but filled at 105 has a 5% slippage rate. The more illiquid a token is, meaning the less money available on either side of the trade here, the more slippage is likely to occur. So if you're trading very, very small market cap meme coins, you might need to increase the slippage threshold. Although that means that you're increasing the amount that you're willing to pay, okay? Now to adjust slippage, just click on the percentage number above the main swap interface in order to open up the slippage settings. Then of course you can either select a percentage or enter your own custom amount and then click on save settings. Now, you don't want to make a very big slippage setting because you're just opening yourself up to losing money all the time. Generally, you want to keep slippage pretty tight, like 1% or less. But in some cases, for very low cap coins, you might be willing to take that 5% slippage hit. There are many other features on Jupiter that will be familiar to regular traders as well. We have things like limit orders. We have dollar cost averaging, which is very, very useful if you want to set up an order to buy something every hour over a week, for example. We have perpetual swaps trading, and of course, it's up to you on how deeply you want to explore all the facilities on offer here. But the point is that you now have access to the huge numbers of Solana-based altcoins that are being bought and sold every day and are some of the most popular coins of the cycle. Now, if you go to a platform called Magic Eden, you can actually trade NFTs too. And beyond these protocols, you have the entire Solana ecosystem to explore with literally probably thousands of dApps at this point. And that's just Solana. You might also want to dive into other places. We've just covered how to get on chain with Solana, but we have things like the Coinbase Base network, and that requires a whole different setup. You have to buy Ethereum, put Ethereum on your wallet. Maybe you'll need a different wallet. Now, the Phantom wallet does support Base, but there's other networks that the Phantom wallet won't support. So you might need to get a different wallet, okay? Still though, I hope the Solana example is very useful for you and gets your toes into the water, and then you can start thinking about how to set up other wallets, like starting to use Base via your Phantom wallet. So now we know when to buy, how to get on chain, but that leaves another very important question. Now that we're here, what do we buy? Well, there are a huge number of tokens to choose from. In fact, there are now more coins than ever before, and it's getting crazier every day. As recent data shows, incredibly, over 1 million new tokens have been deployed since April in 2024, and it's got so crazy. Some days we have like 50,000 new meme coins a day being launched. It's just nuts. A lot of that activity comes down to the ease with which new meme coins can be launched. It takes a minute or two now. There's a new Solana platform called pump.fun that allows for cheap instant deployment of new meme coin tokens. But still, those are just crazy, crazy numbers, and they really underline a very important point here, and that's that the vast majority of the tokens out there are straight up trash, man. They're either going to go to zero very, very quickly, sometimes within minutes or hours, or just really never get off zero in the first place, okay? For a lot of you guys coming in, you're gonna be better served by actually just sticking to some of the top stuff. Top 100 coins are still gonna make plenty of money. Okay, you don't have to win the lottery by being the guy who gets the next big meme coin. You need to be a bit picky, okay? So when building out your portfolio, you should consider which sectors you want exposure to, how much risk you're actually willing to take. You know, if you're getting these low cap meme coins, that's a very tiny percentage of your portfolio probably for risk percentage, right? It means thinking about future development. It means which narratives are likely to run, then trying to ask yourself which coins have real value and are likely to pick up a lot of attention within those niches that you find personally interesting. And of course, both of these characteristics combined is ideal. But remember, we're not buying coins to hold forever. We're not marrying these bags. The only coin to hold forever is Bitcoin. But with altcoins, we're asking which ones can pick up traction in a bull market so we can sell for good profits. Our intention is to buy low or low enough and then sell high or high enough, okay? We already looked in the first section at the different altcoin categories, so now let's run through how we might actually organize a portfolio. But keep in mind, this is simply to get an idea of how to approach the planning part of making your portfolio. So first, just keep in mind, this is not exactly how you should build your portfolio, right? You'll have your own way of approaching it, but this is a framework for you. So first, major layer ones, right? In that case, ETH is the number 2 crypto after Bitcoin. It's got ETFs, all that kind of stuff. Then we have Solana. There's so much happening over there. Probably going to have ETFs maybe even by the time you watch this video. There's other stuff out there too, like the Telegram Open Network or the Aptos blockchain. A lot of great choices. Avalanche, you know, super great quality blockchain, getting a lot of hype this cycle. Now for layer 2s, something like Base looks really great, but it has no token. Then we have other things like Blast, which is new and maybe has a lot of room to grow and run. There's Arbitrum and Optimism, but these tokens have, as investments, have struggled to maintain a lot of value for investors. So you have to actually dive in and think, okay, well, what's going to drive people to buy this token in the future? That's where layer 1s like Aptos or Sui or Solana become more interesting than a lot of these layer 2 plays, okay? So we're gonna look at layer 1s. So put some layer 1s in there. Maybe we wanna get some utility tokens in, right? Something like Chainlink, right? Really solid play for exposure to decentralized finance. Huge selection of protocol tokens out there, Aave and stuff like this as well. We might wanna diversify across chains. So maybe we wanna buy some Aerodrome over on the Base chain. Maybe we want to buy some Jupiter or some Radium on Solana for some more DeFi exposure. Stuff like this, right? So big cap stuff here. As for narratives that have a bright outlook for the cycle, maybe you're really into artificial intelligence. So you want to put 10 or 20% of your portfolio into AI coins. Maybe you're really big on the idea of real world assets. So you put 10 to 20% of your portfolio into that. Maybe you like a few meme coins. You put 10% of your portfolio in there. So for AI, we look at big things like BitTensor, the gaming, you know, you look at Beam or new players like Off the Grid whenever it launches. And if you don't have the time to research specific titles, of course, you can pick up tokens from the gaming ecosystem more broadly. If you can't find a particular game, that's where something like Beam comes in, which is more of an ecosystem play. For exposure to real world assets, maybe you're looking at Ondo Finance. And for meme coins, I mean, you're spoiled for choice, obviously, but some of the big ones that are the big players this cycle and likely to survive, things like dog with hat, right? So your portfolio will break down into a few different places. Maybe it's 20% in Bitcoin, 20% in big layer ones, 20% AI, 20% real world assets, and then like 10% into meme coins and 10% into DeFi, for example. And you don't need 20 coins from each of these niches, by the way. You can just have 2 or 3 coins from each of these and do totally well, by the way. Also, there's even stuff, you can just go so deep, right? There's stuff like the Runes ecosystem on Bitcoin. There's NFTs that you can be buying. There's crazy amounts of things. But again, exposure to any of these niches, you probably just need 2 or 3 tokens, okay? Now, to initially find tokens by sector, you can just go over to CoinMarketCap or CoinGecko. These are the top data aggregation sites in crypto. You can select a specific category. So, okay, I'm gonna go shopping for some AI coins. I'm gonna make a short list of 10 coins that sound interesting. So go there, click on their AI category and start looking into the different coins. However, as I've said though, what I've gone through so far is just an overview, an example to show you how you might want to start looking at, okay, what sectors interest me? How much do I want to put into what sectors? And which coins from those sectors do I want to put money into? Do I want to just stick with safer big cap coins, or do I want to take lots of risks and find low cap coins? Now, later on, I'm going to give you a couple of more detailed portfolio examples, so stick around for that. But first, let's focus in more detail on exactly how to find good coins within each altcoin sector. Of course, there are so many coins on offer that you might actually be wondering how to actually try to pick out good ones and how to avoid the garbage. First of all, let's be clear that some of these coins they don't need to exist, okay? There's a lot of tokens that have absolutely no reason for existence. Do you notice, for example, how Coinbase's base network is doing pretty great without a token, right? And there are cases where tokens simply act as a vehicle for speculation, like meme coins, right? However, as long as we recognize that fact, then it can be okay. Tokens let us speculate. To be honest, we're here to speculate, aren't we? But in general, when we're evaluating a coin, here are some factors to look at that can help put you more on the winning side of the equation beyond just spraying and praying and hoping that other people are going to speculate on the thing you're speculating on. Number 1 is tokenomics. This includes details like the token supply, how it's released. We could say that Bitcoin, for example, is ideal. There's a fixed supply, no pre-allocation, fair distribution at a constant rate through Bitcoin mining. With altcoins, you get all kinds of setups, and the picture is a lot murkier. There might be an unfixed supply. Ethereum, for example, has an unfixed supply, although it's technically reducing its supply. It's a different story. There are a lot of pre-mines, meaning that early investors receive a large amount of tokens. They just print everything on day one and hand it out to a group of individuals who were early investors, for example. There can be token unlocks that release further supply in very large amounts sometimes that can affect the price in a very negative way in the short term. Staking rewards are another way of distributing tokens, but these can be set in, again, a number of ways. There's many different staking mechanisms, a way to delegate your coins. Can you do it through a wallet? Do you need to run a node? All these kinds of questions. And look out for red flags too, such as coins being released too quickly, meaning that the project team might actually cash out and dump the price. And this happens all the time in crypto, so you have to be careful, okay? A lot of fly-by-night teams out here who are they'll launch something, but they'll also just make millions and run away. Or staking rewards that are just set too high, increasing the supply too quickly, more quickly than it can be absorbed by the market demand. Also check the circulating supply versus the eventual total supply, so you know how many more coins are going to come to the market. If you're buying something that has a fully diluted valuation of $10 billion, but the current market cap's only 30 million because only a tiny, tiny fraction of the coins are out, that's a problem. You're going to be dumped on relentlessly by early investors, okay? You should also get an idea of how many coins are in the wallets of the venture capital funds who might want to sell to realize profits. In fact, they need to sell to realize profits. Then you need to know what their vesting period is, when the big unlocks are coming. There's a lot to learn here, okay? Meaning the period during which these coins are locked up and can't be sold. That's the vesting period, by the way. Above all of these points relate back to one rule: supply and demand. Is there enough demand for supply and coming supply? You're basically checking how this supply will evolve over time while assessing whether that demand will continue to be sufficient for the incoming supply, which is not always going to be true. In fact, often not true in crypto. Number 2, burn mechanisms and staking. So relating to tokenomics, a burn mechanism is when tokens are permanently removed over time, reducing the total supply, while staking requires tokens to be locked up, also reducing available supply. Now keep in mind that supply reduction can push prices higher if enough demand is present. And of course, if the burns actually are meaningful. A lot of things have burn rates that are just abysmally small because there's not enough actual demand for the protocol or the token. Number 3, utility. What are the tokens actually for, and is there actually much interest in any of this? For example, Ethereum and Solana have on-chain utility for paying gas fees. Or for example, you can find some gaming token that's used as an in-game currency, but you have to ask yourself, does anyone actually need that in-game currency? Is there actually a reason for this token to have any kind of demand in the future? Right? Ethereum and Solana, they're gaining users, they do well, people need their tokens to do stuff on chain. But is anyone going to play that Web3 game that you're looking at and really need those in-game tokens? Another utility, of course, is governance. Token holders may get to vote on protocol decisions, but in reality, the majority of holders might have no real interest in any kind of involvement. Most decisions are made by VCs in the team anyway, and buying governance tokens is usually a losing proposition in most cases. There are some governance tokens that do pay money, but if it's pure governance, not interested. Number 4, solid tech that solves a problem. Now, this is arguably the best kind of utility, the coin that actually does something cool. Crazy idea, right? In this bracket, we might put something like Oracle Chainlink or potentially some of those real-world asset projects. Number 5, project documentation. Now, it may sound obvious, but check how the project actually works. What's actually scheduled coming on the roadmap by taking a look over the documentation that should be publicly available for any serious crypto project, except meme coins, but not really serious, are they? Even some meme coins have roadmaps. Come on, other cryptocurrencies. But taking a look at the documentation, you can find out what problems the project is actually aiming to solve. You can also assess the general character of the venture. Is it academic? Is it corporate? Is it left field? Is it just a marketing BS stunt? Wild future claims? We're going to take over the world in 5 years and all real estate everywhere is going to be on chain on our platform. Bullshit. Number 6, the team and the partners. Again, sounds simple, but check out who's actually behind the project. What are their credentials? What's their background? If there are partnerships in place, have the major venture capital firms committed money to this? If not, why not? Okay, check whether or not these people are legit or not just another, project using some other company's product and its tech stack. So many companies will see like, we're working with Amazon. Yeah, you've got your stuff hosted on Amazon Web Service, dog. You ain't working with Amazon, okay? Also, try taking a look at Crunchbase to find out about financial backing and investors. Most projects are listed there. Number 7, hype, mindshare, and virality. Remember that sometimes garbage can pump while good quality tech falls by the wayside. And this often comes down to the attention game. If a project grabs mindshare, it goes viral. Prices can pump regardless of any fundamentals. And that's part of the hypocrisy of crypto you have to deal with, okay? Dumb crap pumps all the time while your very solid tech coin does nothing. Also, let's quickly mention meme coins here, which operate entirely by design on hype and virality. In that case, tokenomics are still relevant to some extent, and knowing who's behind a coin can help. Also help to avoid scams, obviously, and there are times when a founder brings or builds a real community. A couple of good examples of this being the Book of Meme on Solana or Dog on Bitcoin. Both meme coins, you just don't need to care very much about utility and white papers and what they're doing, as none of that crap really matters. Just is the hype there, is the attention there, and can it go up based on attention and hype? So with all that said, we can start finding some strong coins. But crypto, in fact, really any kind of trading always involves some kind of hazard. So it's important that we also know how to manage risk. Look, crypto can offer some crazy gains, huge upside potential. But the flip side is the risk of huge losses too. However, some forward planning, you can actually manage those risks. And here's a reminder, of course, of why that's so damn important. See, every time that you make a percentage loss, it takes a greater percentage gain to get back to break even, okay? So a 20% loss requires a 25% gain to get back to break even, but an 80% loss requires a staggering 400% gain to recover. Do you think your coin's really gonna do that? You can see why we want to keep losses to a minimum. You manage your risk, or the market will manage your risk for you. And the market is ruthless, very efficient, completely merciless. They don't give a crap about you and your bags, which sounds scary. So what can you do? You have to defend yourself. You have to manage your risk. And there are several ways that you can protect yourself. And to begin with, you should make a damn plan. Don't just leap in and start buying everything that you see mentioned on social media, in and out of trades, chasing candles. You're going to get wrecked real quick. Use everything we've talked about so far to consider which sectors you actually are interested in, which tokens you actually think are worth buying and have value. And you can, of course, journal your trades too. What are your entry points? What are your exit point hopes, right? How much you're allocating? How much risk are you taking? At what point would you be willing to cut it at a loss? All of this stuff needs to be kept in mind. Keep organized, okay? Because another issue is that it can get really difficult to track assets when you've got just, so many tokens, multiple wallets, multiple exchanges, multiple blockchains. It's a mess, okay? Keep it neat and tidy, or as neat and tidy as you can. It's always gonna get crazy, especially when you start getting into the altcoins, but just try. Plans don't always go as intended, but this way, if events steer off course, you're better prepared to respond and to learn. Also, consider your risk tolerance. Now, this depends on, of course, personal circumstances. Everyone's going to have different approaches to risk. If you're 19 years old with no dependents, no mortgage, and a few $1,000s to burn, you can take the hit, man. You can lose everything and bounce back later. You'll be fine, right? Or are you married with kids, paying off a house, and you don't really have a lot of extra cash floating around? You're probably not going to want to take a lot of risks in that situation. Look, there are infinite other life situations. There's two of the more extremes, right? So the point is, how far along the risk curve do you want to go? Bitcoin's the lowest risk. You take more risk the further down you go. NFTs, meme coins, all that stuff, very, very high risk. And a good point about crypto is that a lot of risk variation is possible, from a portfolio that's 100% Bitcoin to a stack of nothing but meme coins, or more likely, something in between with a relatively safe core of Bitcoin and Ethereum and Solana, maybe 4 or 5 other sort of big blue chip coins, and then some, degenerate trades at the edges on NFTs or meme coins with a much smaller percentage of your stack. Ultimately, you should never trade with what you can't afford to lose. Crypto is risky. You could get hacked. You could lose everything tomorrow like that. And that's going to depend entirely, of course, on the individual situation. Once again, relatedly, there's something called position size. Now, crypto is risky, but it's not equally risky across the board. So how much you put into any one given token probably should depend on the characteristics of that specific token. I would have no problem being 100% in Bitcoin because I can sleep well at night knowing that I hold 100% Bitcoin. And if you have something like 95% of your holdings in Bitcoin and 5% in some cat coin, you'll probably be fine. But if you have 95% in a cat coin and 5% in Bitcoin, you're probably going to wake up sweating and going, oh my gosh, am I going to lose everything? What's going on? It's too much risk. In addition, there are wallet and app and exchange risks. So again, to keep secure, use a hardware wallet for sizable holdings like a ledger. Find a link down below in the description. No, seriously, these are great. You can then also have multiple hot wallets for interacting with different decentralized applications, and use burner wallets even containing minimal amounts of crypto in case you approve a bad contract or get hacked or something like this. Look, it's very easy to create new wallets, so use as many as you need to stay safe, okay? And keep your core holdings behind the safe walls of a vault in a hardware wallet. Remember that anytime you move coins to a decentralized protocol or to an exchange, you are taking risks. Just because these decentralized finance protocols are operable doesn't mean they won't get hacked, doesn't mean that rug pulls won't occur, doesn't mean that mismanagement doesn't happen, doesn't mean that bankruptcies happen. Okay, all that stuff happens. These are all risks you need to weigh, okay? You don't want to keep your money sitting on a centralized exchange either. They're for trading, they're for buying and selling. Get out, move your stuff again to a hardware wallet. Also be careful when signing wallet transactions, because a wallet transaction is irreversible, it's mutable, it's put on the blockchain. And you always need to make sure you're on legit sites and not scam versions, which will try to get you to approve scam contracts and steal all your money. Basically, stay on high alert at all times. You're not being paranoid enough, okay? There are people whose full-time job it is to steal your money. Let's pick up on a couple of common mistakes that can lead to big losses. And first, of course, is trading without knowing what you're doing. Now, crypto is global. It's a 24/7 market with almost no barriers to entry. It's a very exciting place to hang out, but it's also very easy to start trading without any prior research and not knowing why tokens are moving up or down, really, at any given moment. But from there, the market will quickly get to work, okay, and start redistributing your funds over to traders who have done, well, bit more preparation than you did. Remember, it's a very tough market and it's player versus player, and there's a lot of people who have a lot more technical edge than you do. The good thing about this point, though, is that you're here watching this video, so you're already on the right track and you're already going to be ahead of a lot of people who don't have this knowledge. One more error often made by noobs is, of course, chasing the market. This means that instead of buying early or during dips and then selling into greed, you're doing the exact opposite. Okay, you're chasing after every green candle, every big pump. You're buying the top on every hot coin of the week, only to see the prices reverse. You're not being patient. You're not holding your conviction bags. This comes down to FOMO, and to counter it, again, you need to make a plan early, ideally, and stick to it. The plan helps keep you on track, while accepting that some opportunities are simply going to and inevitably will pass you by. You're not going to catch everything. You're simply not. So disabuse yourself of that notion. But don't worry, because again, there's always new opportunities. There's always something new happening. Try to be on the next train, not the train that's already left the station. There are times when all you have to do is just be patient and preserve your capital. There's a lot to be said for just preserving your capital, okay? Play the game of don't lose money. By the way, there's another huge, common, and critical mistake, which of course is not taking profits, or something you probably hear me banter on about all the damn time in my videos. That's one that's so important. We'll cover it separately later. And next up, let's look at portfolio building. Now, with everything we've covered up to here, we can now address the practicalities of really building a portfolio. I know we gave an example of that a bit earlier, but now we're going to really dive into it. And first, we need to keep in mind 5 points. 1, functionality. What is the purpose of the token that you're buying? Does the tech actually solve a particular problem, or are the tokens just trading purely on attention? That can be fine, but you need to understand. Number 2, market opportunity. Is there actually room in the market for the project to grow? Is the market cap valuation so insanely high there's not much upside left? Is this actually a popular niche? Like, AI coins have great potential because AI is very, very popular, whereas a lot of like social-fi coins are not very popular because it's not a very strong niche. So what's the upside potential? We want to focus where everybody is focusing. That's where the money's flowing. Number 3, adoption. Is there going to be growing future demand for whatever the project you're buying is building? Think about that. Does it already have an engaged community? How's the community growth looking? What's the on-chain token growth looking like? Number 4, tokenomics. Does the token distribution make sense for you? How will the supply and demand dynamic develop in the future? And again, I know we've kind of covered some of this stuff already, and this is sort of the TLDR version of it, but it's very, very important, so please keep these things in mind. Number 5, how is the project managed? Do you have confidence in the team behind it? Have they shown themselves to be good actors? Do they take criticism, or are they just pieces of shit? Don't invest in projects from pieces of crap, okay? Then think about your risk tolerance. As we talked about, this depends on your personal circumstances, but can also depend on how much of your total investment portfolio is actually taken up by your crypto portfolio. It's an important point, right? Is your total investing portfolio, you got stocks, you got real estate, you got gold, and maybe only 10% of your total investments into crypto. Maybe you're 100% into crypto, that's fine too, but just understand where you're positioning crypto in your wider investing perspective. And if you're all in on crypto, then you might want to have a more conservative crypto stack, okay? On the other hand, if crypto's only, say, 10% of your larger portfolio, then maybe you've got a little more space for a bit of risk in here, with maybe a bigger percentage of your portfolio than you would have taken otherwise. And it follows that you may be comfortable with coins further out along the risk curve. Obviously, that's for you to assess. For some of you guys, just investing in Bitcoin is going to already be risky enough in a portfolio that's just S&P 500 and US Treasury bonds, right? But let's run through 2 possible portfolios, a safer one and a riskier one. So first, let's make a conservative portfolio focused on big cap coins. We're going to include Bitcoin, of course, as our main holding, as it's an asset that I feel comfortable holding regardless, okay? Through whatever crap the market can throw at it, Bitcoin tends to be just fine. We also want some Ethereum here, as it's kind of the silver to Bitcoin's gold, if you will. And at the time of recording, Ethereum was only the second asset to have an ETF in the US markets. We'll probably have others coming soon, like Solana. And the other large cap I'd want exposure to is indeed Solana, which is a little more volatile than Ethereum and Bitcoin, but has been a dominant coin this cycle. Pushing forward in terms of new development and user adoption, and with plenty of upside potential left as a top 5 layer 1 coin. That in itself is a simple, solid portfolio. To be honest, it might be enough for a lot of people, but I might want to add in some of the other current big narratives. So let's say 40% Bitcoin, 30% Ethereum, 20% Solana, but then I also want exposure to AI and real world assets. So I'll put 5% into Tau and 5% into the Ondo token. Now I've got exposure to 2 extra niches in the crypto market. So that's good. Now let's go for a riskier approach. We're not going to go full on hardcore degen, just aping in every meme coin possible. We'll include more mid and small cap coins. Again, we still want to have a little bit of Bitcoin, a little bit of Ethereum, a little bit of Solana, but we're also going to add in a couple of smaller layer ones. So we're going to look at Aptos and the Telegram Open Network. Then we're going to include newer layer 2 exposure, get something like Blast, for example. We're going to get exposure to DeFi and Base at the same time through the Aerodrome token, which is the Aerodrome DEX token. AI and gaming, they're big interests of me, so we're going to throw some BitTensor Tau in there. We're going to throw some Beam in there. And this time, I'm throwing some meme volatility into the mix, so I'm going to grab myself a bag of Pepe as well. As for allocation percentages, 15% of each on Bitcoin, Ethereum, Solana, Aptos, and Telegram Open Network, 5% each on Blast, Aerodrome, BitTensor Tau, Beam, and the Pepe meme coin. This leans us away from the riskier tokens a little bit, or maybe you could say 10% each on everything would shift you towards a higher risk setting as you're taking a little more risk on some of those riskier plays within the portfolio. So you can see how a risky portfolio is, depends not only on the coins you pick, but also on how much you choose to allocate between larger and smaller caps. And to be honest, even our riskier portfolio example here is still relatively low on the risk spectrum. There'll be people who just go all in on coins that are under $100 million market cap, and that's like much riskier. Or you're only focusing on trying to find the next big thing in the meme coins, and you're only buying things that are less than $1 million market cap. Now, just to be clear, these are example portfolios to demonstrate how you can adjust the makeup of your holdings to create a cryptocurrency exposure that's riskier or a little more conservative, depending on your own circumstances and aims within your own investing life. But there are infinite different personal approaches that you can take towards portfolio building, and yours is going to have your own personal touch on it. Remember also that a common mistake is to hold so many different tokens that you just simply cannot keep up with or track all of them. Very common mistake. So it can be best, especially at first, to opt for a more minimal approach. Keep some good cash as stable coins on the side, okay? 5 coins, you're going to easily be able to keep tabs on that and rebalance when necessary. 50 coins, you're not going to be able to unless this is like your full-time job. Plus, maintaining a portfolio that's easy to manage means you'll be better prepared when it comes to an absolutely crucial aspect of cryptocurrency trading, which we're looking at right now, and that is how to take profits. I've made many, many videos on the topic. Best time to sell, strategy for taking profits, etc. But this is an overview distilled from some of that information. So if you don't take profits from the market is going to take them back from you. Cannot stress that point enough. Bear market will come and everything's going to go down. Most of these altcoins are going to go down 99.99%. You have to take profits. This is highly speculative stuff we're investing in here, which sounds easy. Oh, I'll just buy low and sell high, but it can actually be a lot trickier than expected for a few key reasons. Number one, you're not sure whether the top is actually in. When it's time to sell, you're questioning your timing. But here's the thing, you're almost certainly not going to sell the exact top, and that's completely fine. If you took profits and the price moves a little higher, fine. Don't worry about it. It was a successful trade and you made money. Remember, no one ever went broke taking profits. Number two, you're trading emotionally. In a raging bull market, it's so easy to get caught up in all the BS, the euphoria, thinking that you're a genius. You're not a genius, just a bull market. Sorry to burst your bubble here. But until profits are locked in, you haven't made a single penny. That screenshot on your phone, it ain't worth shit, man. So wait until after you sell before you celebrate. And if you ever feel like showing off your gains before they're realized, probably the moment to consider hitting sell. Number three, you don't have a plan. With no plan, the market's going to eat you up and you're more likely to round trip all of your gains because you haven't set any targets or considered any ways of selling, which we'll come to in a moment. Number four, you're not confident in your ability to find another trade. You got a winner, and you're going to keep riding that one forever. It's all or nothing on the current positions that you have. If you think like this, you'll be reluctant to sell because then it's the end of the ride. Well, you do need to get off the ride at some point because the bear market will come. Keep that in mind. But there's always new trades out there. There's always new opportunities. You can short the market. You can find new meme coins, whatever. Selling for cash is an active trade in itself, by the way. And there are times when it's the best asset to be holding on to. You need to think of it like that, okay? Keep those points in mind because being in cash is also a key trade at certain points in the market. Let's look at some top signals. First, we have the Pi cycle top indicator, which is a free indicator you can find. You're looking for here is for the 111-day moving average, the orange line on the chart to cross above the green line, which is the 350-day moving average multiplied by 2. This crossover indicates that the price topping, or at least it's worked so far, has been pretty damn accurate. So if you sell when that happens, you're probably going to get enough profits. Will it remain accurate now that Bitcoin is a larger asset, now that the ETFs are in play? I mean, no one can be sure. Well, I don't know the future. Do you? Be great if you do, let me know. Next, we have the MVRVZ score, which again has been pretty effective up until now. Here you're looking for that orange line, the Z score, to push up into the pink zone, the MVRV zone, because that indicates that the market value has greatly exceeded the realized value for the asset, meaning that you're in an overheated market. Previously, this has corresponded within 2 weeks with the top of the market cycle. But again, there are no guarantees it works forever. And one more signal, this time on the price chart, is Bitcoin dropping below the 50-week exponential moving average. You can even probably really say the 21-week exponential moving average. 50 weeks, definitely a confirmation that things are pretty cooked. Price can test this line through a bull run, by the way, but when it loses it decisively, further downside is on the way. This is a late signal, means we're past the top. When it confirms, it's over. It confirms it's time to cash out. Wait for the next cycle to start up. Another good one is the weekly MACD. This comes a bit earlier than those other signals. Not the pi cycle. Pi cycle is definitely the leading one you need to pay attention to. When you see the blue line cross under the orange line, then it's time to get out for Bitcoin. Now, you won't perfectly get the top in this situation. You'll be a few weeks late, but you'll also definitely get out before it's way too late. So you'll sell at 200K instead of 250K, but you're not going to ride it down to 100K or 70K or whatever it might be. You can also be tying this all back into those 4-year crypto cycles, keeping track of when we should be hitting the top, and there are social signals that will come to your attention too, as mentioned earlier. There's stuff like the Coinbase app climbing up to _1 in the App Store rankings, and there'll be greed all over the timeline. Again, these are things you should be paying attention to. Watch the social situation. It's also very important, as important as those technical indicators. Suggestions that we're in a never-ending super cycle. It's going to go up only, if Bitcoin gets to 200, 250K, for example, and people are going to say, well, it's only going up to 1 million now. People keep moving the goalposts. That being said, BlackRock is now a major player. Bitcoin is becoming an asset institutions will buy and hold, meaning there will likely be new kinds of top signals coming in. The market's always adjusting. It's a very dynamic place. Maybe headlines about corporate treasuries stocking up Bitcoin and sovereign wealth funds buying Bitcoin and all this kind of stuff, following Coinbase's lead in 2021. More crypto company IPOs, stuff like this. And one other point, some of these signals can actually flash at various times throughout the bull runs. You want to look for a confluence of many of them happening at the same time. Okay, that tends to be at least a local top, if not the top. Okay? And certainly if you see a majority of these things flashing, then time to start heading for the exits, guys. Although before that happens, you should have already thought about how you're going to sell. Can you just offload everything all at once somewhere near the top? I mean, that would be perfect, right? Sure, that might work for you. But in turns, selling into a really big high stakes decision, a different option might be just to ladder out, meaning that you take portions of profit out in intervals on the way up, okay? So every time Bitcoin's up, I don't know. There's so many different ways you can do it, right? But it would typically involve selling percentages of your bags at certain price points or after certain percentage point moves, thereby locking in profits while maintaining exposure to the market, meaning that this can be a very stress-free method for taking money out of the market. For example, your Litecoin's up 50%, you take 10% out. It's up another 50%, take 10% more out. And you keep doing that again and again and again until you think the market's approximately cooked. Also, don't forget about taxes. Unless you live in a tax haven or country or something like that, capital gains taxes are going to be part of your trading package. You should also include taxes into your personal calculations and remove and put aside funds to pay for tax when you close trades. It's not sexy, it's not fun, but you're going to have to do it, making sure that you're not trading with the money that you're going to need to pay for your final tax bill, because you will screw yourself super hard, okay? Finally, you can also start to think about how to diversify your gains. Now, the question here is basically, what are you going to do with all that money that you made in crypto? Buy more crypto? Probably not a great idea in front of a bear market. When a crypto bull market has run its course, you need to get out and be in cash. Okay, you can keep your Bitcoin multi-cycle. It's a different question. All the altcoins, you need to sell those damn things, okay? Keep in mind that before you start diversifying with all that cash you just got, right? Concentration to build wealth. Being in crypto, build wealth. Diversification preserves it, okay? So you might want to have a nice Bitcoin stack that you're never going to sell, but maybe you're also going to say, okay, I made a great bunch of money on altcoins. Let's buy some real estate. Let's buy some gold. Let's buy some stocks, right? Now you diversified out. Now you're not going to go broke. Now you're not going to lose it all. Keep in mind that for lower risk plays, dividend stocks are a little more conservative option, or just simple index funds, as opposed to going straight into tech and high growth stocks, which are probably going to experience a bear market around the same time that crypto experiences a bear market. You can also simply stay in cash and take advantage of high interest savings accounts. You can do the same with stable coins, but there are a lot of protocol risks if you're using crypto platforms to earn yield, and that's probably not a great idea during the bear market because that's when things break. Also, you can opt for a very low risk approach while the market is hung over after a bull run and then start switching some capital back into crypto after prices have hit their rock bottoms. And the cycles are, again, looping back around to the start, really. Until then, though, thank you for watching. I hope that this video has been useful, hopefully a bit of fun, and that it's going to help you, put you on the right track to making truckloads of money in crypto. Thanks for watching.